Good morning, everyone. A very warm welcome to the webinar on analysis of Union Budget 2025 with respect to the proposed amendments in income tax, GST, customs, and foreign trade policy. I would now like to introduce our speaker, Mr. Vivek Jalan, who is a qualified CA, MBA, qualified LLM, and LLB. He is also the chairperson of the National Fiscal Affairs and Taxation Committee of BCC and I. He is the regular speaker at various professional forums specializing in both direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any query, please feel free to write in the chat box. We will address all queries at the end of the session. Now, I would like to request Sameer sir from VILGST to say a few words. Over to you, Sameer sir.
Samir, you have to unmute, I think. You're not audible. Samir, you're not audible.
Can you hear me, Vivek? Am I audible now?
Yeah, now you're audible.
Yeah, hi. In fact, I think I was muted earlier because everyone who was joining was muted. So probably I was not the co-host. So now uh, I can see my video and I'm not unmute. I can unmute myself. So welcome to this webinar, this budget webinar. Good morning, Vivek. Good morning to all the participants. And thank you for joining on the Sunday morning. We were in dilemma whether to have it on Monday or Sunday. Then we thought it would be better to have it on Sunday itself because Monday everybody would be busy. So there's a lot of discuss on direct and indirect taxes. So we'll start with the session with direct taxes probably and then we'll move to indirect taxes. As Namrata said, if you have any queries or any doubts, you can put it in the chat box, or you can unmute at the end of session and you can directly ask the query to the Vivek, and we'll try to cover all the queries as we go along. So, welcome to this session once again. Over to you, Vivek, to start with the session. Thank you.
Thank you, Samir. And good morning to all the participants, to Samir from VILGST, and all members of Team Tax Connect who have been instrumental in getting this webinar going on a Sunday morning just after the budget. I'll share my screen. Is the screen visible, Namrata? Namrata, is the screen visible?
Yeah,
Yes, sir, it's visible.
Yeah.
Yes, sir, we can see.
Okay, so we have heard a lot about the budget over the last few hours, yesterday in bits and pieces. And we'll, in this webinar, discuss threadbare as far as possible and the time permits from scratch to the end on each and every provision, specifically the provisions which are very important and which are applicable to almost all the businesses and the taxpayers. Do not go much into the PPT, right? Because, in these times of internet and technology connections. There were some glitches. The final PPT will be mailed to you, but the PPT which was prepared yesterday, there are some technical glitches, and so we could not present that PPT. So I will verbalize as we go along the provisions as per the finance bill and the memorandum. But first, overall, a macroeconomic view of the budget, right? And the macroeconomic view of the economy and how what is proposed. So the total budget is 50 lakh crore, up from last year. Last year the budget was 48 lakh crore. This time it is 50 lakh crore. Out of that, the revenue budget is 34 lakh crore, and the capital receipts is 16 lakh crore. Out of capital receipts of 16 lakh crore, the borrowings is around 15.7 lakh crores, right? So 50 lakh crore budget, 34 lakh coming out of the tax revenue, right? And other revenue receipts. Tax revenue is 28 lakh crore, 16 lakh crore coming out of capital receipts. Out of that, 15.7 lakh crore is the borrowing, right? And we talk about fiscal deficit. We have heard about fiscal deficit. What is the fiscal deficit? This 15.7 lakh crore of borrowing divided by the total GDP of India, that comes to 4.4 crores. So approximately the total GDP of India is 350 lakh crores, 3.5 trillion rupees, and therefore the fiscal deficit is 4.4%. The last year's estimated fiscal deficit was 4.9%, but the government has done a better job as far as fiscal prudence is concerned, and it is down from 4.9% to 4.8%. What it means for us taxpayers as well as for the businesses is that the government has borrowed lesser money than what it had budgeted in the last year, which means that the economy has done better in terms of management of expenses. Now, this is important for us, the tax revenues, right? So we have heard a lot about individuals paying taxes. Mr. Gupta and some others are complaining of audio problem, but at our end, the audio is perfect. Avik and Namrata, please tell me in case there is an audio problem, if you
Vivek,
cannot hear me.
yeah, Vivek, I also received the
Yes.
call whether the audio is a problem because I can hear, I can see
I
the
can hear.
presentation, I can hear also, but there are certain participants who are not able to get the audio. Can you just check with the connection possible?
Just a second. Avik, can you please check? From my end, I think connection is fine.
So if somebody is facing audio problem, I request to maybe disconnect and rejoin on once again. Maybe then we can have a proper audio then.
Yeah, so I think few participants are saying that audio is fine. I
So we
think
can,
the participants who are facing a problem, yeah, they can, disconnect, join and see their bandwidth at their end.
yeah. That would be proper. Yeah.
Yeah. So, so the revenue receipts, the tax revenues, that is important for us. The corporate tax, right? That has been budgeted for 10.8 lakh crores, up from 9.8 lakh crores. So around 11% growth in corporate tax is concerned. What is important is around 11% growth from 12.57 lakh crores to 14.38 lakh crores, right? So around 10 to 11% growth has been also budgeted for personal income tax. We have all heard the Honorable Finance Minister yesterday. She said due to the personal tax amendments, and the customs duties exemptions, there was a loss to the exchequer of 1 lakh crores, right? So even if we take 50,000 crores as a loss due to the personal tax provisions and the personal tax rebates, concessions, even then the personal tax is uptick by around 80-90,000 crores, or sorry, 1.8 lakh crores. So, which means that the personal tax front is very buoyant, and the CBDT is expecting a lot of buoyancy even after such a huge rebate mechanism and the concessions in personal tax. Will come threadbare on the personal tax and the corporate tax front going forward. And other revenues are there. Customs is flat as we expected. Central excise is flat. So this is the macroeconomic picture, friends, and we'll directly come to the personal tax front, then the TDS, and then the other provisions, including the non-resident provisions, etc. Right? So the big bang reform which has come and announcements were on personal tax front. This budget did not, so to say, live up to the expectations as far as the corporate tax or the business tax is concerned. But for the personal tax, there were the unprecedented changes. None of us, I'm sure, would have expected such a huge relaxation as far as personal tax is concerned. So let us understand what is the relaxations for personal tax. And here we have a full chart for you on how much you are saving, right? Generally, we compare the old regime versus the new regime. This time we are comparing what would be your tax as per the current slabs in the new regime, and what would be your tax as per the amended or the proposed slab rates as per the Union Budget 2025. First of all, important to note is all the amendments that are being made except for one amendment on NPS, National Pension Scheme. All of these amendments, they are only for the new tax regime. So the new tax regime would expectedly be the only tax regime going forward, as we all know from the last few years, from 2020-21. And this time the government has made it much more clear. First, the slabs in the new tax regime as of now are 0 to 3 lakh rupees exempt, 3 lakh to 7 lakh 5%, 7 lakh to 10 lakh rupees 10%, 10 to 12 lakh rupees 15%, 15 to 20, 10 to 12 is 15%, 12 to 15 is 20%, and over and above 15 lakh rupees is 30%. What was the demand of taxpayers was to increase the initial threshold limit, right? So they have done that, and they have made it simpler. Also, the demand of the taxpayers was to bring in a new slab of 25%. They have done that also. So what are the new slabs? Let me come to the new slabs. 4 lakh rupees income is exempt, right? If you have an income of 4 lakh rupees exemption, you do not even require to file your returns, right? 4 lakh to 8 lakh, the tax rate is 5%. 8 to 12, it's 10%. 12 to 16, it's 15%. 16 to 20 is 20%. 20 to 24, it's 25%. And above 24 lakh rupees, it is 30%. So now they are 7 tax slabs, nil to 30%. 7 tax slabs are there. What we have heard is up till 12 lakh of rupees, there would be no income tax. How is that? That is through the rebate mechanism under section 87A. of late, there has been a lot of issues under Section 87A due to CPC issues in the return filing for the assessment year 24-25. I will come to how that is resolved also, right? But let us come one by one. As of now, while I'm talking about as of now, what is currently there? The threshold limit for nil tax is 3 lakh rupees. That has been extended to 4 lakh rupees. However, as of now, the rebate under Section 87 capital A, that is available up to 7 lakh of rupees, right? So 3 lakh exempt, and till 7 lakh, you do not have to pay any tax by claiming a rebate under Section 87 capital A, right? Now, this rebate under Section 87 capital A threshold has been increased to 12 lakh of rupees. So up till 4 lakh rupees is exempt. And if your income is 12 lakh of rupees, then you can claim a rebate of 60,000 rupees for the income between 4 lakh to 12 lakh of rupees. But what do you need to do? You need compulsorily file your return. 4 lakh of rupees, you do not even require to file your return. But above 4 lakh rupees, you don't need to pay income tax, but mandatory to file your return, right? Next. As of now, as I said, there is a issue with the CPC. So the CPC changed their return format in July 2024. And the rebate under Section 87 capital A, the rebate under 87A is not available as per the new return for special rated income. What is the special rated income? Like short-term capital gain, right? The rebate under 87A is not available as per the CPC return JSON file. However, there is no provision in the law which does not include short-term capital gain in the threshold of the rebate under 87A. So matter is with the Bombay High Court, and now they have amended their JSON file also, but even in that JSON file, you have to manually go and enter. There were many notices under 87A disallowing the short-term capital gain for the purpose of rebate. Now that is settled for the assessment year 24-25 after the new JSON format. However, in the proposed scheme and with the proposed Section 87 capital A limit of 12 lakh of rupees, this 12 lakh rebate does not include any special rated income like capital gain, short term or long term, right? Or lottery income or any other special rated income. So, for example, in case you have a short-term capital gain of rupees 6 lakhs in the current financial year 25-26, when you are filing your return, you can claim a threshold exemption of 4 lakh. However, on the 2 lakh of rupees excess short-term capital gain, you have to pay 20% as the short-term capital gain of 20%, that is 40,000 of rupees in addition to the other income, right? So this is a major amendment. This 87A rebate now is subject to the other special rated income, right? Next, in case your income goes beyond 12 lakh of rupees. So in case your income, total income for the year 25-26, assessment year 25-26 is 12 lakh 10,000 of rupees. So what is seen, even though the income exceeds by only 10,000 rupees from the minimum rebated amount, the tax would be around 71,000 rupees. So for 10,000 additional income, you have to pay 61,000 rupees additional tax. That is also relaxed under marginal relief. It's still there in the current rebate mechanism also. It is also proposed for the new rebate of 12 lakh rupees, right? Up till 12 lakh rupees income. So in case your income is 12 lakh 10,000 of rupees, you get a rebate of 61,000 rupees and you have to pay an additional tax only of 10,000 of rupees, right? So this marginal relief is also there in the current dispensation also. We heard the Honorable Finance Minister say that in case your income is 12 lakh rupees, you end up saving 80,000 rupees per annum. In case your income is 18 lakh rupees, you end up saving 70,000 rupees per annum. And in case your income is 25 lakh rupees, you end up saving 1 lakh 10,000 rupees or so per annum, right? How is that calculated? It is on your screen. So if you can see on your screen, the 12 lakh row, right? Total income 12 lakh row. As per the existing slab rate, your tax is 80,000 rupees. Tax as per the proposed slab rate is 60,000 rupees. Benefit of rate slab is 20,000 rupees. So the total benefit is 80,000 rupees, right? Similarly, if you see the 18 lakh rupees total income row on your screen, 18 lakh row of rupees, the total benefit is 70,000 rupees. And if you see the 24 or 25 lakh rupees row of total income on your screen, you can see there is a total benefit of around 1 lakh 10,000 of rupees per annum. So this was important. We have been saying from the last many days. We have proposed it also before the Ministry of Finance. And this was important because the middle class had to have more disposable income in their hand and they had to consume more goods or services for the GDP of India to rise. We have seen the last year's GDP was 8.2% and the current year's GDP is 6.4%. It is estimated to be 6.4%, though there is a huge fall in GDP. And for the new financial year 25-26, it is important that the GDP is revived. How can the GDP be revived? It can only be by putting disposable income in the hands of the middle class and this sector of the people who are the main consumers of India. We are seeing the GST revenue also this time. For the month of January, we have seen a little uptick of 12%, but for December, we have seen a muted uptick in the GST revenues also. So what we understand is that the government wants to give away this revenue of the exchequer and take it back the GST way through the consumption route. And once the consumption is increased, then the entire economy's GDP would be increased. Also, the government has proposed many other relaxations for exporters, specifically MSME exporters. So their focus is on middle class, MSMEs, and of course, manufacturing in this budget. Now we come to TDS and TCS, which is a pain area. We expected a huge revamp in TDS and TCS provisions, which was not to be in this budget. However, very important is what the finance minister has announced during her budget speech. The next week, a new finance bill for income tax will be tabled before the parliament, right? And it is expected that the Income Tax Act would be more or less halved and would be less complicated, right? So as of now, if we see ballpark, there are around 940 sections in income tax, including the A, B, C sections like 193, now 194, 194 A, B, C, etc. Right? All including, there are around 940 sections in Income Tax Act. Out of that, for the last 5 or more than 5 years, more than 140 sections have already seen a sunset. So they are not required at all. Also, there are many other provisions, explanations, sub-explanations. Sometimes there is a explanation even for a proviso in the section. So all of this, it is expected, would be merged. A lot of redundancy in the Income Tax Act would be uh, done away with, and the Income Tax Act is expected to be much more shorter as we see the next week the finance bill being tabled. Now, how they would move ahead with this finance bill, the new proposed finance bill, whether they would invite public comments or whether they would enact the new finance bill immediately, that requires to be seen. However, the Honorable Finance Minister in a budget speech was also very clear that deregulation, what the economic survey has proposed day before yesterday, she said very clearly that deregulation is not a destination. It cannot be a one stage phenomena. It has to be done over a period of time in phases. So a lot of action and amendments in income tax we would see going forward. TDS and TCS, long-standing demand across from various forums. I think all the chambers of commerce, we have proposed in one tone that TDS at the rate of 0.1% on purchase of goods and payment made for purchase of goods more than 50 lakh rupees cannot exist simultaneously with TCS under 206C1H at the rate of 0.1% on the sale of the same goods, right? So as of now, in case you as a seller have a turnover of more than 10 crores or the purchaser has a turnover of more than 10 crores and there is a sale and purchase transaction of more than 50 lakh rupees between the seller and the purchaser, then the purchaser is required to deduct under 194Q 0.1% TDS and deposit it in the income tax in the TDS return and write the TDS challan per month. However, in case the payer does not deposit or deduct and deposit this TDS under 194Q, then you as a seller would be required to collect the same TCS at 0.1% and pay it to the exchequer and file the return. When do you practically know that the deductor has not deducted the TDS under 194Q? It is only almost at the end of the financial year or at most after 3-4 months when the 26AS form gets auto-populated, right? And this delay in payment of TCS to the government, this inculcates interest as well as penalties. And along with this, they have a provision that in case you collect and do not pay the TCS, then there are prosecution clauses, etc., etc. Right? So now what they have done, they have accepted the demand of the industry and they have deleted this TCS under 206C1H at the rate of 0.1% on sale of goods of more than 50 lakh rupees in a financial year, right? Last budget, Finance Act number 2, 2024, they had proposed a low TDS or TCS deduction certificate for 194Q or 206C1H. They are not tinkered with that. Naturally, the low TCS deduction certificate provides provision that would automatically be deleted. However, the low TDS deduction certificate for 194Q as per the last Finance Act number 2 2024 that prevails. So 194Q prevails, and even you can get a low TDS deduction certificate for 194Q still. However, no TCS at 0.1%. Lot of rationalization is there under TDS and TCS. So TDS rate under 194 LBC, right? For the payment by securitization of a trust, right? That TDS was very, very high of 25 or 30%. That has been reduced to 10%. Now, very important, first I will come to 194I rent, right? On your screen, you can see point number 10, right? So there are primarily three sections for TDS on rent. 194I, 194IA, 194IB. 194IA is of course for separate, it is for sale of immovable properties, 194I and 194IB. So 194I is for other than individuals and HUF, and IB is for individuals and HUF, right? Now, the slab rate, the threshold rate for 194I TDS on rent, that was 2.4 lakh rupees per annum, right? So if you pay a rent as of now of more than 2.4 lakh rupees per annum, then you are liable to deduct TDS at the rate of 2% or 5% under 194I, right, per annum, right, on all the payments of the rent. Now, this 2.4 lakh rupees per annum has been amended to 50,000 for a month or part thereof. Just like 194 IB, 50,000 for per month or part thereof. But hold on. What we understand is there is a difference between 194I, 50,000 per month or part thereof, and IB, 50,000 per month or part thereof. Under 194 IB for individuals and HUS, 50,000 per month or part thereof, there is a provision wherein the TDS has to be deducted and paid on the last month of the entire financial year, right? Or in case the assessing ceases to be a tenant or pay the rent during the year, right? So for the entire financial year 24-25, you have to pay this 194 IB TDS only in the month of March 2025. That also subject to the total amount of rent which was paid in the month of March 2025. So for example, every month, if you are an individual or HUF, every month you are paying 40,000 rupees per month, right? And in the last month you pay 1 lakh of rupees. Audio not clear. Avik, is the audio clear?
There was some issue in between.
Now is it clear?
You can,
Not much.
yeah, you can try now.
Avik, can you please check?
No, it is okay.
Sir, it is okay. We can hear you.
Yeah, it is okay now.
Okay. Okay. So maybe I have to come closer to the screen. Okay. So for 194I, the proposed amendment is that in case you are paying more than 50,000 rupees per month, it is understood that per month you have to deduct TDS under 194I as per the rates thereof. Right? This is not 6 lakh rupees per annum, just like 2.4 lakh rupees per annum as of now. Right? So month on month, you have to see the rent payout and deduct TDS accordingly. This is a catch and one has to be careful. So for the whole year, say from April 2025 to March 2026, or February 2026, you go on paying 40,000 rupees per month rent. However, in March 2026, you pay 1 lakh rupees of rent. Then on that 1 lakh rupees, you have to deduct the TDS under 194I because it is more than 50,000 rupees per month. Similarly, for any particular landlord, you are paying, less than 50,000 per month. You change the landlord and you pay, more than 50,000 rupees per month. Then for the new landlord, where you are paying more than 50,000 per month, you have to deduct the TDS, right? So it is what is important again to reiterate is 50,000 rupees per month and not 6 lakh rupees per annum. Various other threshold have been increased under TDS, although they are very minor increases, and to businesses, I do not think there would be much of a difference. So interest on securities is nil to 10,000 rupees, 194A interest other than interest on securities, right? This is important. From 50,000 rupees for senior citizens to 1 lakh rupees for senior citizens. This is what the finance minister also announced in a budget speech, right? And 40,000 to 50,000 rupees for others. Dividend for individual shareholders, 5,000 to 10,000. So these are very, very minor, increases as far as businesses are concerned. Brokerage or commission, again 50,000, 15,000 to 20,000 rupees. Fee for technical services or professional fees under 194J. So all the slabs have been increased from 30,000 to 50,000 rupees. This may have some kind of minor impact for businesses. So there is a small amendment for section 206C. Again, subsection 1, wherein TCS was collectible at the rate of 2.5% on timber obtained under forest lease or other than forest lease. So even if you get a timber out of a forest lease and you are just trading in timber, then also you need to collect TCS at 2.5%. And any other forest produce other than tendu leaves. So tendu leaves, no TCS, but any other forest produce also, you have to collect TCS when you are selling. The issue was that for traders who are not, selling goods under forest produce under the scheme of forest lease, even the traders, they had to collect TCS at 2.5%. So now what they have done, they have removed that only in case you are dealing or a trader in timber, right? Then you have to collect TCS and the rate is reduced from 2.5% to 2%. However, if you are dealing in any other forest produce other than timber, you are not, you are trading in that, no TCS is required to be collected. If you are dealing in a forest produce under a forest lease other than tendu leaves, including timber, then 2% TCS would apply. Current taxation, harmonization of significant economic presence, applicability with business connection. So under section 9, we see an explanation which states that in case you have a sales office in India or a licensing office or any other office in India just to purchase the goods in India and to export it from India. You don't intend to sell it in India. You don't want to do a third country export. So one way of dealing is to do a third country export. You tell the supplier in India, in case say you are based out of London, you tell the supplier in India to directly sell to or ship the goods to the customer in say Japan, right? Another way is you can open a sales office here and you can purchase the goods in India for exporting out of India so that your customer does not know about the supplier. So under explanation 1 of 9.1, it is very clear that the purchase of the goods for export, purchase of the goods only for export, that would not result in business connection. However, explanation 2A, it talks about significant economic presence, and the business connection would be there in case there is a significant economic presence. And it comes out that a significant economic presence would be construed in case a person is dealing with a purchase of goods in India in any way. So roundabout explanation 2A of section 9.1, it can be seen or it can be construed that significant economic presence would be attracted in case the goods are purchased in India only for the purpose of export also. Therefore, there is an apprehension always that there can be a demand on these sales offices or, so to say, licensing offices in India also. Now they have clarified this, they have amended the provisions, and they have clarified that in case there is a mere purchase of the goods in India for the purpose of export, then it would not attract the provisions of business connection. So there would be no tax business income in India, which is generated in this kind of a transactions. Clarity in respect of redemption of ULIP plans, right? So section 1010B, it exempts any income, any received by the way of redemption or of the ULIP plan, UNIP linked insurance plan or life insurance plan. However, it is subject to two conditions. In case the insurance premium is not more than 2.5 lakh or 5 lakh, as the case may be per annum, and in case the insurance premium is not more than 10% of the sum assured, right? However, it was seen that in case of ULIP plan, there was a confusion regarding the condition where the provision relating to the 10% of the insurance premium that was concerned. Now they have clarified that even in case the insurance premium is more than 10% of the insurance premium, then it would result in the ULIP would become a capital asset and the capital gain tax would be attracted and there would be no exemption under section 45(1)(b) of the Income Tax Act. Exemption to startups, section 80 IAC, right? There was a sunset clause under 80 IAC for startups. So what is the section 80 IAC? It is an exemption to startups for 3 years out of 10 years at the option of the startup. However, there are 3 conditions. Number 1, the turnover should not be more than 100 crore of rupees. Number 2, there should be a certificate from the ministry, that is DPIIT. And third is there was a sunset clause till 1st of April 2025. So now they have increased this sunset clause or extended this benefit to the startups for exemption under 80 IAC till 31st of March 2030, right? For 5 years flat extension. So all the startups now, they can start their businesses in the next 5 years and they can take the benefit of ATIAC, 100% income tax exemption for 3 out of 10 years. A very important amendment for the semiconductor and the display manufacturing ecosystem, right? So very recently, we have seen the Prime Minister had gone to United States, and there was a deal for setting up semiconductor and display manufacturing factories in India, right? And however, these semiconductor or display manufacturing factories cannot be set up until and unless we import the technology, right? However, to provide the technology, the foreign companies or the non-residents, they do not need to be in India. They can merely provide their services from outside India, or they can provide their technology from outside India without actually being in India. Right. So, but their business, their income in India was construed as business income, and they had to prepare their financials and file their income tax returns in India. Now, a presumptive taxation scheme has been introduced under Section 44 BBD, wherein 25% flat of their turnover or total income in India, that would be considered as presumptive income in India and taxed accordingly, right? So, effective taxation for such non-residents or foreign companies who are providing the technology or services for these semiconductor industries, that would be effective tax would be around 10%. Right. Also, very important for all these foreign companies, many of the times it is required to send their expats to India for a period of 1 year, 2 years to handhold the Indian industry to get going with the technology. Right. So, in case even the expats come to India and stay here for 1 or 2 years, right, or more, even then it would not be considered as a even then this thing presumptive taxation scheme, this would continue. Benefits for tonnage tax scheme to inland vessels. So tonnage tax scheme was applicable only for sea-going vessels on the basis of the load of the ships and the number of days they have done business. Now they are applicable to inland vessels. Also, there is another amendment in the tonnage tax scheme. If you apply for the tonnage tax scheme, then the officer has to pass the order accepting or rejecting the application within 1 month. So now that has been increased to 3 months because physical verification, etc., also needs to be done and it takes time. Next, trust. Right. Over the last 5 years, we have seen that the trust Section 11.1023C mechanism has gone through a complete overhaul. In fact, if you see my last budget's post-budget video, deliberations, it was as if the government did not have any trust on trusts, right? The kind of squeeze they were going through and the kinds of regulations they were going through. So in the last budget, the trust mechanism was further simplified. The simplification had started. When in 1023C, that was completely taken off and all the trust would now be exempt under section 11 and 12, right? No two separate regimes for trust. So the process which started in 2019 around was what? All the trust they needed to be they needed to file the applications under section 12A. Then they would be granted the registration under 12AB, and they would be eligible for exemption under section 11 and 12, but subject to the conditions of section 13. Right? Too many sections. I will come one by one to simplify this. Right? So first, all the trust in 2019-20, it was decided and the Finance Act enacted, wherein all the trust had to compulsorily apply for registration, whether they were an existing trust or a new trust, right? So they had to formally apply for the registration under section 12A. And this registration was valid only for 5 years. In case the trust has not started operations, they could get a registration, but that would be valid for 3 years only, right? And all of those trusts who had applied there for registration at that point of time, their renewal of or reapplication of registration time has almost started, right? Or will start in the coming 1.5 years. So what they have done in this budget is they have increased this timeline of getting re-registered from 5 years to 10 years. So, and it is applicable to those trusts which have a total income of or had a total income of less than 5 crores in the immediately 2 preceding years from the date of application, right? So at that time, in case in the last 2 years, all these trusts, they had a total income of, I'll come to that. They had a, yeah. So this is on your screen, the provision. So if they had a total income of less than 5 crores for 2 immediately preceding years, they can continue to be exempt without re-registration or reapplying for registration for another 5 years. From 5 years, their threshold or the time limit for registration has been extended to 10 years. Another issue in trust was that under section 13, in case any particular benefit was provided to any specified person, like a trustee or any person who had contributed more than 50,000 to the trust, that had to be disclosed, right? Or reported accordingly. No, the problem was that even the relatives of such specified person like trustees, etc., and the firms in which they were related, right? That was very difficult to find out and even disclose. So on this pretext that you could not disclose the relatives or the interested organizations of the trustees or the members of the trust, that led to cancellation of the registration of such trusts. So now they have amended this provision and they have stated that no requirement to disclose the related parties or the firms or the organizations in which such trustees or members of the trust they are related, right? And for such minor breaches, there cannot be any cancellation of registration. Like you do not disclose the name of one trustee, cannot mean that your registration would be cancelled. So minor breaches, no cancellation of registration of the trust. Also, the threshold limit of this 50,000 for the persons to be a specified person like trustee member, etc., that has been increased to 10 lakh of rupees, right? So, there are certain amendments in the block registration. Okay, section 275, right? So section 275, it has various timelines for passing of penalty order for the joint commissioners. So what was the issue? Section 275 requires that the quantum order, that is the order of the tax and the interest, that could be passed by the assessing officer. But the penalty order, that had to be passed by the joint commissioner within 6 months of the quantum order or the end of the financial year. In which the quantum order was passed, right? There are various time limits on this. Many of the times it was seen that the assessing officer, he has forwarded his quantum order to the joint commissioner and the joint commissioner has not complied with the timeline of passing the penalty order, and many of such penalty orders were quashed and as per section 275 only on the basis of limitation, right? So now they have relaxed this provision, right? And they have first of all made all these time barring periods consistent, right? And second, they have even amended section 275 to say that the assessing officer themselves can pass the penalty order on the basis of permission which is received from the joint commissioners, right? Most of the time barring periods exclude the period of the stay given in a particular case by any court. The question is, when is the start date and end date of the period of stay? They have clarified now the start date is the date when the order of a court, say High Court, has given a stay to a particular demand. So the start date for not including in the time barring period, that would be the date of the order. Whether or not the officer has got a service of the certified copy or not. However, the end date would only be the date when the certified copy of the order was received for vacation of the stay, right? So start day, passing of the order, no need of certified copy. The end date would be the date when the certified copy of the order was received for vacation of the stay. Section 72A and 72AA, right? Briefly, I will tell you this is a big, issue over a period of time, and we had been taking the benefit of the provision. So as of now, in case a particular company, a loss-making company amalgamates into another company, right? And the accumulated losses are there for, say, a period of 4 years. When such company merges into the new company or amalgamates into the new company, it is said that the accumulated losses get a fresh lease of life, right? This is seen as evergreening of the losses by the department, right? So in this budget, they have said that the losses can be carried forward for 8 years maximum from the day when the loss first originated. You can do X number of amalgamations or demergers or mergers, but the time period for carry forward of loss would be only 8 years from the date when the loss was first originated. And this will be implemented from 1st of April 2025. Therefore, we have another February and April, so 2 months. In case any amalgamation merger happens within these 2 months, then this amendment would not be effected, so to say. From 1st April 2025, no more fresh lease of life to the unabsorbed losses or carry forward losses. Foreign transaction taxation for the foreign companies or the non-resident companies or the subsidiary of foreign companies where there is international transactions, and almost every year we go to the assessing officers and there is a determination of arm's length price. Many of the times it is seen that the foreign associated enterprise is the same. The associated enterprises is in the same place. There is no difference between the transaction. For example, many of our clients also, they are just trading, they are purchasing and selling the goods to the associated enterprise. But arm's length price is by and large decided every year. There is an assessment every year, right? And many of the times the AO refers the case to the TPO every year for determination of arm's length price. So now they have provided for block assessment and block determination of arm's length price, right? So arm's length price can be decided for the current year plus 2 succeeding years, following 2 succeeding years at one go by the transfer pricing officer. The entire mechanism that would be notified in the rules. So it is very important to see the rules also in this case, because it is not automatic, so to say. The the validity of such block transfer pricing ALP determination, that would need to be done by the TPO before starting the block uh, assessment or calculation of ALP. So the validity would be checked first, and the process of determination of validity, that would also be notified further for the future years in case already assessment has been done. So all those ALPs would do not to be considered to be assessed after this determination. That has also been provided, right? So the entire scheme that would be further notified in the rules to come. Okay, very important for TDS or TCS. As of now, in case there are non-filers of TDS or TCS, then under section 206AB and for TCS 206 CCA, a higher rate of TDS or TCS is deducted or collectible for non-filers of return. This 206 AB and CCA, this has been done away with, because practically what used to happen is on the first day of April, we used to see there was a utility in the income tax portal. We used to download which of our clients, which of our vendors, they have not filed their returns, and for them we used to tag it in the ERP that higher rate of TDS had to be deducted, and in case they used to file their return during the year, then again we used to detag it and the normal provisions would continue. So now there is no, this caused hardship to all the taxpayers, and this provision for higher rate of TDS TCS deduction for non-filers, this has been done away with. But hold on, 206 AA, that still prevails. That is for those vendors who have deactivated PAN numbers, non-Aadhaar linked PAN numbers, or who do not provide their PAN numbers. For them, the higher rate of TDS or TCS would still prevail accordingly. So while non-filers higher rate of TDS is done away with or TCS is done away with, but for deactivated PAN numbers or those not providing PAN numbers, for them the higher rate of TDS or TCS still prevails. So the income of the non-monetary benefits or perquisites which was provided to employees which are salary of 50,000 rupees per annum, right? That would not be considered as a perquisite that was provided under 17(2). Nobody earns up to 50,000 rupees per annum as of now. This limit was fixed more than 20 years back. Similarly, in case an employee was earning less than 2 lakh rupees, then the foreign cost of travel for foreign medical treatment would be not included in perquisite. However, this 2 lakh rupees of salary limit, this was determined more than 30 years back. So they will now give the new slabs of this 17(2) perquisite, the salaries limit slabs for this perquisite and for the travel abroad for medical treatment. ATCCD NPS Vatsalya, there was a new scheme for NPS for parents to invest for the minors. So that has been brought under ATCCD NPS scheme, and but the threshold limit of 50,000 still remains. And this is under, of course, the old regime. Okay, annual value of self-occupied house property, I will explain with an example. You have, two properties. If you are living in Delhi, you have two properties in Delhi itself, right? One property you are self-occupying, the other property is vacant. You can get, you may not offer the deemed value, annual value of the vacant property to taxation. However, the property was considered to be not liable to taxation under deemed rent provision only in case the property was vacant due to uh, employment, carrying on business or profession in a place other than where the property was located. So in my example, in case you have two properties in Delhi, one you are occupying, one you are is lying vacant, you have to show that the property is vacant only because of employment, business or profession in other regions. You have to show that it was vacant only because of these reasons. Now that provision has been done away with, and it is flat exemption. You can have two house properties, out of which one you can self-occupy, one you can have it vacant, or both you can have it vacant. You do not need to show a reason. So some of the taxpayers, I would not say many, were getting notices and they were explaining this to the officers, and somehow some of these explanations were also made up. So now they have decided that this provision for a property being vacant due to employment, business or profession in other areas, that has to be done away with. So this is a beneficial provision and beneficial amendment. Crypto assets for the crypto exchanges in the G20 summit, it was decided that the crypto exchanges in all the locations, I think more than 50 locations were there. 50 countries have signed this treaty. So crypto exchanges in all these locations, they have to share their data. So that is why they have amended this provision and brought in this new section 285 BAA. So all the reporting entities, crypto exchanges, they will have to report these the transactions in their exchanges. Okay, so we have already passed the time for income tax. We also have to discuss. Okay, we'll discuss the last provision for penalty, extending the processing period application, seeking immunity from penalty of prosecution, right? So section 270 double A, in case you pay off the interest and tax amount within 1 month of the passing of the quantum order, then you can seek immunity from penalty or prosecution. And the officer, within 1 month of the application, he has to pass an order accepting or rejecting your application under 270 double A. They have said that within 1 month time is very little for the officer to pass an order and for the SSC to represent as to why he seeks immunity. So the time limit for passing the order only, not for application for immunity under 270 double A, the time for passing the order only, that has been extended for 3 months, right? But the time limit for application under 270 AA, that still remains intact. Updated return can be filed within 4 years. If you file within 1 year, 12 months, 25% extra tax interest, 2 years, 50% extra, 36 months, 24 to 36 months, 60% extra, 36 to 48 months, for 70% extra you have to pay. In case between 36 months and 48 months, you get a notice under 148A, then this updated return would not apply. But if you get an order under 148A also in the same 36 to 48 months, nullifying 148A notice and providing that 148 notice need not be issued, then you can still file updated return under 139(8)(a). So these are by and large the important provisions of income tax. We'll quickly come to GST and customs. Very, very important amendments which are made. If you go to our YouTube channel, we had discussed under GST all of these amendments in December 2024 after the 55th GST Council meeting, right? So three very important amendments we'll discuss over here under GST. First, safari retreats is negated. You cannot get input tax credit, and input tax credit would be blocked under section 17 subsection 5 clause D of CGST Act for goods or services purchased for setting up of warehouse or construction of a building for the purpose of renting, right? So this is the crux of it. You can go to our video on our YouTube channel. We had a session with VILGST in December 2024. There I had explained threadbare on this provision. But no input tax credit would be available. That is the amendment under 17(5)(d). The important thing is the amendment is notwithstanding any High Court or Supreme Court order. So they have clearly and unarguably, no more argument is there required. They have said, and they have gone for a review of the Supreme Court order also, and they have said that no input tax credit would be available. Next, for input service distributors, all the taxpayers, they have to take input service distribution registration now from 1st of April 2025. No more cross charge. That is now done. However, what about in case, say, you are a foreign company, you are registered in 3 states in India, you pay a royalty to your foreign company, and that royalty is related to all the 3 states. So naturally, the IGST which you pay for royalty for import of services, that you have to distribute amongst all the 3 states. How do you do that? Say your head office is in Maharashtra, your branches are in West Bengal and Haryana. So you pay from your normal GST registration the reverse charge for royalty under IGST, and then you, so to say, transfer it, cross charge it from your normal registration in Maharashtra to your input service distributor registration in Maharashtra, since your HO is in Maharashtra, and then from ISD you distribute such input tax credit for royalty. But the amended provisions defining input service distributor under 2 subsection 61 as well as section 20 did not have reference to these reverse charge provisions. Now they have amply clarified by inserting such provisions. So you can even distribute IGST through input service distributor registration. Next, most important, invoice management system, which has created a flutter among the taxpayers in GST over the last 3 months, that is here to stay, right? It is very clear now. And they have brought in a provision under section 34 subsection 2 for credit notes. And in case you pass a credit note, not only for discount, but even for sales return or any other, deficiency of goods or services or any other reason, if you pass a credit note as a supplier with GST, you cannot reverse input tax credit until your recipient reverses the input tax. You cannot reverse your output tax liability until unless your recipient reverses its input tax credit, right? How do you know it? As of now, that is the question. So now invoice management system is there, and from a supplier's view, you can see whether service recipient has reversed its input tax credit or not. Customs, 3 important amendments, right? Number 1, provisional assessment has to be done within 2 years, extendable to 1 more year. So provisional assessment has to be completed within 3 years maximum, until unless you are reliant on any other document from the foreign jurisdiction for which provisional assessment cannot be completed. Number 2, in case you have paid excess tax while filing the bill of entry, or you have not paid a certain tax while filing the bill of entry. As of now, the only mechanism was to file an amendment under section 149. Now they have brought in a new provision under section 18 capital A, where you can revise your bill of entries, right? And you can pay additional tax or get a refund. What is important to note is that the time period for refund under section 27 is only 1 year from the date of the tax and interest payment in the original bill of entry. Well, this I think should be challenged because the time period for this refund should be starting from the day when the bill of entry is revised, as it is there under the current provision 149, right? So within 1 year, as of now, the law says within 1 year, if you have paid excess tax in your bill of entry, within 1 year, you should file the revision under 18A and claim a refund, right? Okay, settlement commission, just like income tax, that has been disbanded in customs. And last important amendment in customs is IGCR. So import of goods at concessional rate of duty, Rule 6 and Rule 7. It requires that if you import the raw material at a concessional or exempt or nil rate of duty, then within 6 months you have to clear it for home consumption, or you have to, export it. Now that time limit has been extended to from 6 months to 1 year. And the IGCR returns you have to do only now you have to do monthly, and as per the amended provisions, you have to make IGCR returns. You have to file IGCR returns quarterly. So these are the three important amendments for customs. Many rates of customs have been amended. There are 8 rates now directly. Many of the rates have been reduced. What is very important, we had also, uh, represented on the customs to reduce the rate on various raw materials and even capital goods. Earlier, they were reducing the rate under customs on raw materials only. We had represented from many industries that even the capital goods should be allowed to be imported duty free for manufacturing in India, because the duty on capital goods, that is also becoming a cost of my finished goods in India and making my goods unviable. Specifically for the lithium ion battery space, we had represented, they have accepted this, and now the message is very clear. Please import raw material or even capital goods at relaxed duty rates, manufactured in India, make in India, for India, as well as for export from India. So I think these are the important amendments in this budget. We have to stop at 11, so 5 minutes, I'll take the questions. Okay, Tarun says, in reference to income tax, can one claim marginal relief to pay tax only up to the incremental portion up to 25,000 at par with incremental income without considering tax slab? For example, income is 13 lakh in salary head, difference is only 25,000. Yes, marginal relief means this only, that in case whatever is your incremental income, you have to pay only that much amount of incremental tax till the time your tax burden is lesser than your incremental income. Mr. Rajesh says, if the total income of 11 lakh including salary, short term and long term gain, then no tax payable or short term and long term gain to be paid. So yeah, as I said, short term and long term gain will come under the threshold limit, but it will not come under the rebate under 87 capital A. So 4 lakh threshold exemption you can take, but short term capital gain, 20% tax you have to pay. Long term capital gain, again, if it is under section 112A on securities, you can get 1.25 lakh rupees of exemption, but for the balance, you have to pay 12.5% long term capital gain tax. And on the balance, you can get a rebate of 87A, right? after omitting section 206 AB, what will be the penultimate rate for 194O? Is it 20%? Please clarify. No, 194O rate will remain as it is. However, you see, uh, for non-filers of returns, that has been omitted, right? So, the penultimate rate under 206 AA, if that is your question for the non-PAN cases, then it remains as per 206 AA, that is 20%, right? But 206 AB for non-filers, there is no additional TDS, which is required to be deducted even under 194O. Mr. Naveen says under GST, most company book invoice based on GRN. If credit is less availed, recipient will not pass credit note. Impact on IMS. Yeah, that is true. You know, in case recipient does not have to pass a credit note, but what recipient will not accept the invoice itself. It will neither accept the invoice, it will not accept the credit note. So somehow you have to tell the recipient to reject both, right? Or what you can do, you can take both to your return, GSTR 3B return from your IMS, and there you can apply circular 170 and show both as a net of figure. ITC on credit note sales return discount. Can you explain the practical issues on this, or is it easy to implement and file GST returns easily? So, Ms. Shruti, I have already discussed this for all the credit notes. When you are reducing your output tax liability, you have to ensure that the recipient has reversed the input tax credit. That you can do through IMS. On IMS, you can see whether they have reversed their input tax credit or not. Okay, few other questions are there in the beginning. 75,000 rupees standard deduction, I think, is applicable to people whose income under 194.2, which includes the pension by our senior citizens. Yes, standard deduction of 75,000, that still remains and it includes pension to senior citizens. Will 2 lakh rupees interest on house property be available on both the properties? Yes. I think I have answered all the queries. Okay. Okay, we'll share the PPT with all the participants. I think we have completed on time on this Sunday morning. Thank you again for joining. The video and PPT would be shared with all the participants. Over to you, Samir.
Vivek, there are a few more questions. This has just come in the chat box. You could just take it.
Just a second. Okay, I'll start from below. Exemption of income up to 12 lakh rupees is applicable only in new regime. Yeah, as I said, Mr. Rajender, it is only new regime, not in the old regime. Mr. Prashant says, what if the supplier has uploaded credit note by mistake? So let the supplier delete the credit note. He can amend the credit note also in table number 9 of GSTR 1. Mr. Shah says, what if NFT will be a part of VDA and hence reporting is required by exchange? Yes. Now they have also brought in a new provision that this VDA NFT, which is a part of VDA, that would also be required to be reported by the exchange. Mr. Ajay says now any change in case of inherited shares where cost to be considered on sale of inherited shares of earlier person or share price on the date of transfer to inherited person. No, as far as I think, further fine prints of the finance bill needs to be looked into, but as far as what is being explained in the memorandum, So because time was very limited, we have restricted ourselves only to the memorandum. We have not gone through the entire finance bill. So as far as the memorandum is concerned, we do not see any such changes in the cost of the inherited shares. Hmm. Okay, Praveen, last question. I think, okay, two more questions. Mr. Ganguly says, is RCM applicable if a hotel is paying rent to state government? Uh, Mr. Ganguly, this needs to be seen as to what is the nature of the rent. From what your question seems that this would come under RCM, rent to state government. It is a service provided by the state government, but still the nature needs to be seen. Mr. Praveen says for applicable charitable trust, whether renewable for another 5 years will be automatic. Yeah, good question, Mr. Jain. I think they would come out with a mechanism, but I think it should be automatic, right? But then the certificate under, 12 earlier under section 12 BA, that needs to be, amended. So we need to see how they will amend the initial certificate. Maybe possibly they would ask also for a filing of a mere application for such trusts. Okay, thank you very much, friends. It's 11 o'clock. Thank you very much for joining.
Thank you, Vivek. Thank you for this great session. This was really, no, very elaborate, and you have explained, in fact, all the provisions of the budget that has come in the new budget. But we'll have the one more session when the finance bill is passed and finance act is notified. So we will cover that as well. So thank you to all the participants for joining us on this Monday morning, sorry, Sunday morning, in fact. And we'll see you next time when we have the session and when the finance act is passed. Thank you, Vivek. Thank you to all the Tax Connect team for joining us.
Thank you.
Over to you, Namrata.
Yes. Thank you, Vivek sir, for this wonderful deliberations. And thank you, Sami sir, for coordinating this session with us. And thank you to all the participants for attending the webinar. Like we conduct such webinars every month, and we hope to see you all in upcoming webinars as well. We will shortly share the PPT and the video link to all the participants. Thank you all once again.